Welcome back, students who are taking financial accounting, and in this series of videos we are working on the theory aspect for Chapter 9, the current liabilities and long-term debt. Um in this uh, video, let me get down here, we are going to be talking about bonds. Now, this is theory from the textbook, okay? But I'm going to go over bonds very, very slowly here because bonds, to a certain extent, seem complicated on the surface, right? But the reality is they're not that complicated if you understand the structure and of bonds and their intent and purpose. And of course, if you can associate some of these concepts with something else, it becomes a little bit easier to understand and take in the concepts. A lot of people struggle with bonds and doing the calculations and figuring out the interest expense, but hopefully this video or series of videos, it may take more than one video for me to cover this. I'm not going to say it's going to be 2 videos, 3 videos, or 1 video. I'm going to just go slowly, and however many videos it takes is however many videos it takes. All right. Before we begin, if you look in your textbook, um, you'll see the different sections that relate to bonds. Okay. As far as terminology is concerned, read the textbook first. Okay. I'm not going to go over the terminology. All right. Now, I will, there are the different sections. We have how bond prices are calculated, issuing bonds at par, a discount, and premium, and then, of course, making adjusting entries. So if you've read the textbook in order to get the terminology down, you've pretty much covered these different aspects of bonds. But I'm going to present it in a more visual manner and with a little bit extra, or the way I envision and I think about it in my own mind, in order to be able to get things straight, in order to be able to know where I'm at in the cycles of things. Um, and it's just basically the way I go about thinking about bonds. All right, so with that said, let me begin. All right, when it comes to bonds, having a timeline is important. Okay, um, let's call this 1-1, and let's call this 12/31. Okay, now this is a 1-year period, but bonds can also be for um, multiple year periods. Let's say this is 5 years here, right? So we'd have, I'm sorry, this is 1-1, and this is year 1, year 2, year 3, year 4, and year 5. So this is 1, 2, 3, 4, and 5. Okay. Now notice what I'm doing here. Okay. I am taking this here 5-year time frame, and I've laid it out like this, but I'm also showing this 1 year right here. Okay, I mean, a bond could be for 1 year, a bond could be for 3 months, a bond could be for 6 months, it could be for 5 years, it could be 10 years, it could be for 30 years. Okay, I mean, if you buy, you look at treasury bonds, they're basically, the bonds that you buy from the government, they're basically 10-year and 30-year bonds. Okay, um, so but if you go and you buy, say, bonds from your municipality, it could be a 5-year bond, it could be a 7-year bond. Your municipality being your local government kind of thing. You can also buy bonds from private enterprises, like, let's say, for example, and I know this, I'm using this as a real world example, because I went to where I went to school, King's College. Um, they were they wanted to do an expansion and an upgrade on the school. In other words, their science wing needed to have an upgrade, but yet they also wanted to expand the college. I mean, so they went and they looked at um, various options. They looked for investors to give money. They did things like selling, like you could buy a brick in this one area, with your name on it, and that one brick would cost you $500, but you're in this walkway, you'd have all of these people's names with, and each one donated $500 for that brick with their name in it. They looked at things like, fundraisers. They considered selling stock, and they also considered issuing a bond. Okay, and issuing a bond, they were considering that from a 7-year um, time frame perspective. Okay, so it doesn't matter so much about the time frame. I mean, yes, you do have to worry about the time frame as far as the calculation of things, and the calculation of interest, and uh, that mathematical side of it. But in general, bonds are nothing more than debt. Okay, they're they're a certificate, sort of like an IOU, right? For example, let's just say you go to your bank and you want to buy a treasury bond, a 10-year treasury bond. Okay, that treasury bond, um, you're going to buy, and if we're looking at today, you're going to pay, you know, a price, say X dollars for that bond. Okay, and 10 years from now, excuse me, you're going to cash in that bond, and let's say it was $1,000 bond. Okay, so 10 years from now, you're going to cash in and get that $1,000, right? But what you pay today is going to be less than the $10,000, right? And I'm just going to pick a number out here. Let's just say it's $300. Okay, you're going to pay $300 today, so you're giving the bank the $300, and they give you the bond. That bond is an IOU. The bank or the government, because we're talking about a treasury bond here. The government is basically giving you an IOU, giving you the bond, saying we promise to pay you the face value of that bond, which in this case is $1,000, 10 years from now. Okay, so you have this might look like a sweet deal right here, because you're saying, oh, I'm paying $300 now, and I'll be getting $1,000 later on. All right. Well, yes and no. Okay. The value that you pay today is based upon the present value. All right. There's a present value calculation that gets performed in order to determine what the value of that $1,000 bond is 10 years from now, what that value is today, and that's what you're going to pay for the face value. Well, if that is theoretically the same, okay, in other words, what I'm paying today has the same value 10 years from now, regardless of whatever that dollar amount is, okay, why would I want to buy a bond? Okay, all I'm doing is just, giving the money to somebody else, and my spending value, the value of it, my spending power is going to be the same, 10 years from now. So I haven't gained anything. My money just sat there when I could have put it into a different investment and had gotten a return on my investment. Well, with a bond, yeah, when you buy the bond as a incentive for you to purchase the bond, the bond has an interest rate, a percentage interest rate. And so over the course of time, actually they're called like, it's a coupon. It's sort of like, I don't know if you have in your area where you have like free bulletin boards. I mean, I see the bulletin boards. This is just to give you an idea as to what this looks like. You'll see let's say this here is, a cleaning service, right? and they have their phone number. All right. Now, in wherever you see these free bulletin boards, I see these, thumbtacked to the bulletin boards everywhere. And so here's this cleaning service, and it's basically just a sheet of paper where the bottom of the sheet of paper is cut up, and there's a phone number here. Let me change there's a phone number here, and then a phone number here, and a phone number here. And so what you do is, if you wanted to contact that cleaning service, you would just tear off that little coupon or that little sheet of paper at the very bottom of that flyer, and you would take that and you would take it home so that you can call the cleaning service. Well, basically the bond works the same exact way. This would be the bond, and the bond has these coupons on the bottom, where when the interest matures, the percentage of interest matures, you take one of those coupons and you take it back to the bank and you collect the interest on it. Okay. Now, you don't have to do that. You can let that interest just sit there and sit there and sit there. And when you get to the end of your 10 years, you'll get your $1,000, which is the stated value of the bond itself. And you'll also get all of the interest that was earned during that period of time, right? But if you decide to take and use those coupons beforehand, well, obviously you're getting the interest, as it becomes due and mature, all right? If you used all of your coupons, then at the end of the 10 years, you would only get the $1,000 back. So that's something that, you have as flexibility for yourself as to whether you want to collect the interest right now or collect the interest in the future, right? So that's kind of like how bonds work. Let me erase a little bit of this, and this video is now 12 minutes long. So what I'm going to do is I'm just going to recap real quick here. And let me just go into one more thing before I do the quick recap. As far as the interest is concerned, all right, there is no set interest rate. The interest rate is determined based upon market conditions, or what the willingness. I mean, in the case of government bonds, it's market conditions, but in the case of like the King's College floating a bond, they do their research and they decide upon an interest rate. And let me just as an example say the interest rate that they're going to give is 8%. Okay. Now think about what they're doing here is, they want to raise, let's just say $7 million, $7 million in order to renovate their science wing and also expand by building another building. All right. So they want to raise $7 million. So what they do is, they can consider doing is creating bonds and selling the bonds, all right, in order to raise the 7 million. Now, remember, you're going to be buying that bond at at today's present value. So even though the maturity value is going to be $1,000, okay, they're not going to get the $1,000 today. They're only going to get $300. So they have to sell a hell of a lot more in bonds in order to raise the 7 million, right? Down the road, right, they're going to have to pay back the face value of all of those bonds, okay? So they're, remember, it's an IOU. I owe you $1,000. So down the road, instead of, if they raise $7 million in capital, down the road, let's see, this is what, 3.5 times. So down the road, they're going to have to approximately pay back 25 million, okay? Because they're getting the money at, they're getting $300 today, but they're going to have to pay back $1,000 down the road. They're getting 7 million today, but down the road the face value is going to be approximately 25 million. I'm not doing the math here in order to get this absolutely right, okay? But just to give you the idea. Now, also, during that time, they're going to have to pay interest, okay? And depending upon, the terms of the bond, all right? In this case here, we're saying that the interest rate is 8%, and let's say the interest is paid semi-annually, all right? And that's generally, a default, a standard. It's the most commonly used one. So they're going to pay interest semi-annually, which means that every 6 months they're going to have to pay interest. So at the end of the first 6 months, they're going to have to pay the 4%. Okay. Then at the end of the next 6 months, they're going to have to pay 4%. And of course, you have the same issue with year 2, with year 3. Actually, let me do that in blue. They're going to have the same issue with year 2, year 3, year 4, and year 5. So in year 1, they're going to have to pay interest at this, because they're paying it semi-annually. They'll pay it halfway through the year, and they'll pay it at the end of the year. And then year 2, they'll pay it halfway through the year and at the end of the year. Same for year 3, same for year 4, and then of course same for year 5, or in their case, they go all the way out to year 7. All right. So just realize that, yeah, they're borrowing, they're getting $7 million. They also have to pay the interest during that 7-year time frame, and then they also have to pay the face value at the end of when they become due. All right. And remember, it's an IOU, and this might seem like a a bad thing to do from the perspective of the college. Okay. And it seems like, it's a good thing for you, because if you buy the bond, because you collect all of the interest over that time. Okay. The reality is that if they do their due diligence in order to determine whether they want to float a bond or not, it's actually not that bad. It's because remember, you're only talking, they're getting $300 today. Okay. Right. And so they want to borrow 7 million. Well, 10 years from now, that 7 million is going to be worth 25 million. All right. So in today's dollar terms, they're borrowing 7 million today, but in today's dollar terms, they're going to be paying back, quote unquote, $7 million, 10 years from now, which happens to be 25 million. So, because of the time value of money, they're not paying any additional money on the 7 million. What they are doing is they're paying additional money on because they have to pay out interest, right? But if the return by having the renovation on the science wing and creating a new building generates more revenue for them, all right, then they take out that 8% interest in revenue, all right, from that revenue, and that's what they use to pay off the the interest on those bonds. And of course, from that revenue, they also have to put into set aside the equivalent of the 7 million or 25 million, all right. So the face value, all right, of that bond, so that they can pay those bonds back. But if they know they're going to generate enough revenue, then floating the bond and having to pay that all back makes sense, all right? And financially, they'll be able to do that. Okay. So I know the slide got a little bit messy here. All right. So let me erase this, and I'm just going to quickly kind of like go over it again. And because now I'm at 20 minutes already. All right. So the whole idea behind a bond is that it is an IOU. Okay. And whoever is issuing the bond, let's say it's the government or the college, right? They're going, and let's just say it's 10 years. They're going to say, okay, the face value is going to be $1,000, 10 years from now. but the present value is only, today when you go to buy the bond is only $300. So you as the purchaser of the bond, you're going to pay $300 today and then expect to get $1,000 10 years from now. But remember, that's a present value issue, and there's parity between those two figures. It means you're not gaining anything or you're not losing anything because of the time value of money. What you're interested in is the interest rate. Okay. In today's marketplace, you go into a bank and your interest rate is 0.25%. Okay. If a college is gonna, or a municipality, your local government, is offering bonds at 8%, right? Well, if you've got money sitting in the bank, all right, collecting only 0.25%, it makes more sense for you to go out and buy the bond at 8%, because that's almost like guaranteed interest. You could say, well, if I take my money and put it into the stock market instead, these are financial choices. These are choices that you have to make. With the stock market, you're looking to put your money in and looking for it to go up and appreciate. And sure, you might also be able to get a dividend on that stock, right? But that's, you have to weigh those considerations against the value of the bond and collecting that interest rate. And when I'm looking at the stock market today, today being January 20th, and the market looks like it's going to decline, all right? If I can get a solid 8% interest, I'd rather put my money into a bond than stick my money in a stock market. All right, so collecting the interest rate, that's all depends upon the time frame. Generally, it's paid semi-annually, which means every 6 months. So if I have an interest rate of 8%, that means every 6 months I'll collect 4% on that. Now, I don't have to take that 4% every 6 months. I can let it just sit there and sit there and sit there, right? But you get coupons on the bottom of or as part of the bond certificate, which allows you to be able to cash in those coupons for the interest that becomes mature at that point in time. So you have the choice of getting your interest today, or you can just let it save up, and then at the end of 10 years, you'd get the $1,000 plus all the interest that's owed to you at that time. All right. So that's basically an overview of how a bond works. Okay. I didn't get into the specifics of it. All right. Even though it seems like I am. All right. But I haven't just yet. And we'll get into that start getting into some of that in the next video. Like I said, it's going to take more videos. I don't know how many to cover the bonds, but I'm going to go slowly so that hopefully it becomes clear as to exactly what you need to do as far as bonds is concerned. So I'll see you in the next video.